Well, U.S. stocks are higher this morning, but we are looking at Netflix shares pulling back nearly 4%, and this does come after reporting earnings yesterday. Now, the streaming giant is offering an all-cash deal for $27.75 a share for Warner Brothers Discovery. WBD's global linear TV and cable networks are not part of the sale. Instead, Netflix will greatly expand its premium intellectual property library and subscriber base. It would own WBD's film studios and the HBO Max streaming platform, and it would also own major franchises like DC, Harry Potter, and Game of Thrones. Well, joining me on the heels of the latest earnings report is Jawad Hussain, Media and Entertainment Director at S&P Global. Well, good morning. Thank you so much for joining me. So we are looking at Netflix shares pulling back. So first and foremost, starting with the Warner Brothers acquisition, tell me how it impacts the company moving forward.
Yeah, and I think a lot of the uncertainty and some of the price movements on the stock are definitely related to that because it's this is a long-term play for Netflix. They don't need this. They've had a good growth profile, but this is setting themselves up for, the next 10, the next 15 years of growth. Like you mentioned in the intro, Warner Brothers has some of the most iconic IP out there. They have a large film studio. They create some of the most content production. And so this really will rapidly expand Netflix capabilities in some of those areas that are adjacent, but it might also not move the needle that much in the near term. So I think that's where there's a little bit of a flux and kind of why the market might be a little bit worried about it, or why they might have some questions, because they are paying a hefty premium for these assets, and this is the largest deal they've ever done. And to be frank, Warner Brothers has changed hands quite a few times over the last decade, and it hasn't always gone smoothly. So I think those concerns are warranted, but I think what it does is it really gives Netflix, which has built up this great platform, which has built up a content engine basically from scratch. It gives us a huge amount of new firepower to kind of take it to the next level.
Yes, and speaking of which, we're still digesting Netflix's earnings that came out after the closing bell yesterday. So do you think the company can keep its strong growth trajectory?
Yeah, I think so. That's the dichotomy. The underlying performance and trends are still very strong. I think growth came in for the year in 2025 at the high end. They kind of talked about another 12 to 14% growth, margin expansion of over 200 to 300 basis points, free cash flow growth. So all of those things are going well. They gave a couple of different markers. 325 million subs, which is up at least another like 20, almost 25 million for the year, if not more. You saw ad growth, advertising revenue more than double, and they're expecting it to double again. And they gave kind of a number of around 3 billion for 2026. So all of these aspects, and the content engine continues to do well. So it seems like everything is still going very smoothly. And while it's still a very competitive dynamic, Netflix is continuing to excel and do very well in the overall marketplace, and with different types of content, with their film, with their live. They just started podcasts, so they're doing a lot of different things, and it still seems to be working well, which should continue to give it the ammunition to grow and expand margins, over the next year.
Yeah, and I think you mentioned a key word there, and that is competition. So what does competition actually look like when it comes to the streamers?
Yeah, so I think that's the thing. I think we have to broaden our view of competition. It's not just television, it's not just film. I think it's entertainment more broadly. And so that's when you come into the social media platforms, the TikToks, the YouTubes, kind of what they're doing, how much time of share that they're taking from an entertainment perspective. I think that's where Netflix is kind of looking. It's looking beyond just the standard television market that has historically been its bread and butter. And I think that's where it's really looking to expand, and that's where there's a lot more monetization opportunities. And so, while it's a traditional kind of market, maybe a little bit more mature than what it was, I don't think they're at the end of their rope on growth. But these other opportunities, whether it's advertising, whether it's events, things of that nature, still give it significant ample room to grow. And the competitive landscape, while robust, Netflix has shown that it is very good at adapting and finding new ways to monetize its massive customer base.
And finally, before I let you go, what does the bidding war between Paramount, Skydance, and Netflix actually say about the industry?
I think it shows that scale still matters, and that these assets, while if you look at a year or two ago, they were trading at a much more depressed level. The reality is, key, content is still king, and premium assets still have a lot of value. And if you want to be able to be, successful in this competitive landscape, having this type of IP, having these type of exploitable assets, is very much important. Now, this might be one of the last crown jewel assets out there, so it's not surprising that there has been a little bit of a bidding war, and that Netflix is going after this and Paramount, and they're both going to continue to prioritize it.
Well, we will have to leave it there for today, but thank you so much for joining us, and thank you so much for breaking down the latest earnings.
Thank you.